So, Chris, what is the current interest rate outlook for the UK, and how are companies navigating the uncertainty?
Yeah, thanks, Jean. Well, after what feels like years and years of low interest rates, we've just been through some of the fastest and steepest hikes to rates recorded in history. That's across the G3 and UK, the US, and Europe. And we now face 16-year highs in policy rates for all three countries. Now, clearly, that's had a big impact on the cost of financing, mortgage rates, which we're all painfully aware of, but also investment and saving rates, which have clearly benefited from a higher base rate. So today we're going to cover a range of topics across interest rate fundamentals, a brief look on the outlook across the UK, and some thoughts around what the Bank of England are having to tackle, and then some practical hedging methods to help companies de-risk against interest rate volatility. So I thought we'd just start with some basics around why companies manage interest rate risk. When do they look to manage the risk? And that really gets broken down into probably 3 to 5 key areas. Now, companies are typically exposed to interest rates either through their assets, such as cash or investments, but more importantly, across their liabilities. So that might be loans, revolving credit facilities, leases, bonds, other forms of financing. So how and when the exposure arises and when companies choose to actually manage interest rate exposure really depends on individual circumstances. We kind of bucket these into 3, key areas, but there's another number of factors that come into it. So there's a strategic element of this. Companies clearly have treasury policies to keep a certain proportion of fixed and floating interest rates. So that's an ongoing activity that most companies will try and balance depending on the levels of debt and cash. There's the opportunistic side of hedging and managing interest rates. So are we in a very low interest rate environment? Are we in a very high interest rate environment? Those will clearly impact decisions on the type of financing or the type of investments that companies are looking to get. You then have more event-driven or corporate event-driven activities. So that might be divestments, that might be M&A. Is the overall leverage or level of debt increasing or decreasing? That will clearly have a material impact on how you approach the interest rates, your financing rates, and how you manage that risk. And then we've got currency impact, which we'll touch on a little bit today, but through years of very low interest rates, wasn't a huge amounts of differential borrowing, say in euros versus sterling. That's now drastically different. Euro rates are substantially lower than sterling rates, and indeed other currencies around the world. So currency comes into a little bit of play, in particular with expansion outside of the UK. So I thought we'd start with what is an interest rate, which seems like a bit of a basic question, but it's a term that can refer to many things. Typically, when we're talking about variable or floating interest rates, we're talking about some kind of benchmark. So in the UK, that's either base rate, which the Bank of England set, or SONIA, which replaced LIBOR. In the US, we refer to overnight rates as SOFR, that replaced dollar LIBOR. And then in Euro market, that is predominantly still on a Euribor basis. So when we talk about benchmark rates, it's a variable rate that's typically used in most floating rate financing agreements. We then have the concept of forward rates. So effectively, where are those variable overnight rates in a tomorrow, in a day, in a week, in a month, in a year, in 10 years? So the market has forward rates for all benchmarks, and that's how hedging instruments are priced. Now, we've just shown a current snapshot on the screen here of where the SONIA forward curve is currently. And you'll see from that lower left chart, we're up at 5.2%. It then dips at around 5 years' time and then slightly increases. So the shape of this curve is important for a number of factors. In a normal economic environment, and it feels like we haven't had much of a normal environment for about 20 years, but you would typically have an upward sloping curve, i.e. there's a regular expectation that rates will increase. Currently, as you can see, we're not in that scenario. We have a downward sloping curve or inverted curve, as it may be referred to. And that is effectively the market pricing in the expectation, not the guarantee, but the expectation that the Bank of England will start to cut interest rates. So again, that is the path you can see with rates bottoming out somewhere around 3.5%. Now that is just a snapshot in time. The forward curve will be moving every day, every minute, every second, but that will also be impacted by data announcements. Something the Bank of England have said will change the shape of that curve. We also talk about swap rates, which are very important to manage interest rates. So the swap rate is effectively the average fixed rate over a period of the forward curve. So on the right-hand chart there, we've just shown the next 5 years, which is a snapshot of the chart on the left, showing that forward curve and showing where the average rate is. So that blue line, just over 4%, is the fixed rate equivalent for the next 5 years. So if you wanted to pay fixed over the next 5 years, that is the rate you'd be paying, and you'd be receiving SONIA. So that is a very simple form of hedging SONIA rates. Again, those fixed rates will be moving around every time, and as that forward curve moves around, the resulting fixed rate is moving up and down. So what factors can influence interest rates? There are a many wide range of factors that impact interest rates, and we've just shown the last 16 years on the chart here, and huge amount to unpick. I'm not going to go year by year to explain everything that's happened, but certainly it feels like we've been hit by some kind of drama almost every year that hasn't been forecast. And if you think about pre-2008, before the financial crisis, interest rates were roughly around 5% and had been at that level for quite some time. We then had emergency measures from the Bank of England and indeed every central bank around the world to artificially reduce interest rates. So the Bank of England went through an aggressive round of cuts, pretty much down to 0%. And then we had a whole host of other issues, the European debt crisis, Brexit, more recently COVID, Ukraine war, and then obviously elevated inflation rates. But the key thing here is there are a number of external factors that will impact interest rates. So whilst the central bank is in control and in charge of setting policy rates, there are many external factors such as inflation, GDP, fiscal policy, and indeed the monetary policy that the Bank of England set to effectively control prices.
And Chris, it was very timely, but obviously we had the UK inflation data out this morning. So now that inflation rates have declined to 2%, do you think the Bank of England will start to cut rates?
It's a very interesting question, and for the last 6 months, well, if I go back to actually December, January time, there were 6 or 7 cuts priced in or expected to be happening in 2024. Now, clearly none of those have materialized. The inflation rate has taken longer than expected to come down, but a lot of policymakers have, whilst they point toward the 2% targets, many of them have stated they need to see a sustained level of inflation at those at the target level of 2% before they can then take action. So I think it's still probably a wait and see moment. I think it's unlikely they're going to cut at the next policy meeting. And there are some concerns, and certainly in the US, that a number of policymakers are saying that core inflation, and the UK's core inflation is still high at around 3.5%. That is a more important inflation metric to monitor, not just the overall headline inflation. So I still think there's a wait and see moment. And of course, with the election coming up, the Bank of England's in somewhat of a blackout period, not wanting to politically interfere. So I think it's a wait and see over the summer, but certainly there is a ongoing expectation that they will start to cut rates, but equally we could see more of a plateau as we've seen over the last 6 months. So we thought we'd just share some basic examples of hedging interest rates. So we've got a scenario here where a company has a borrowing facility, could be an RCF or a term loan of sorts, where the company's paying SONIA to the loan provider. The company doesn't want exposure to SONIA, it wants certainty on its interest costs. So in this scenario, it would enter into a interest rate swap, which is a very simple agreement where for a given period of time on a given amount, would be agreeing to pay to the hedge counterparty, being Lloyds in this scenario, a fixed rate of interest, and then over that period, Lloyds would be paying the SONIA interest to the company, which then services the loan. So it's a very neat instrument to remove exposure to uncertainty, provides a fixed known cost of financing. And again, in this situation, the company's left with just a fixed exposure on its financing cost. Important to note that an interest rate swap or any hedging agreement for that matter is a separate contract to the lending. And that's actually beneficial in many ways. The lender doesn't necessarily need to be the same as the hedge provider, and vice versa. The hedge provider doesn't necessarily need to be part of the lending. There are some scenarios where you may have a pool of loans. You might be hedging different loans all at once. You might have multiple hedges hedging multiple loans. So by keeping the two instruments separate, you have a bit more flexibility in terms of amending those or indeed restructuring them at a later date should circumstances change in the future.
And would you ever see clients doing this the opposite way round?
Yes, so we've shown a scenario here where the company doesn't want exposure to floating rates and wants exposure to fixed rates. There are the inverse scenario, and actually that's quite topical at the moment, given we are at highs of rates and there's the expectation that rates may lower or reduce in the future. Clients that have fixed rate funding or indeed are issuing fixed rate funding at the moment, a number of them are opting to do the opposite hedge. So that's effectively swapping fixed rate debt and wanting to pay floating rates. So again, if you're issuing a bond today, yields are at kind of 4.5%. There may be a view that actually over time, and especially if it's a longer term financing structure for 7 to 10 years, for example, there may be a view that actually there's enough fixed rate debt within the company and a proportion or a balanced proportion of floating rate debt might be preferable. So in that scenario, you'd have the inverse of this interest rate swap. So the lending would be fixed, the company would be receiving fixed on the interest rate swap and paying SONIA. So it's then removed all of its fixed rate exposure and it now wants to benefit from a view that SONIA will fall in the future. So again, can be flexible and can be in either direction.
That makes sense. Chris, I think we've just got a message here saying that they can't see your slides. I don't know if you want to reshare quickly and see if that fixes it.
I will try that.
We'll see if that works.
Okay, hopefully that can be seen. Please let me know if you can't. So we touched earlier on currency funding, which again has become a lot more topical. Now, companies will typically raise financing in their domestic currency, but equally, if it's expanding into other jurisdictions or has overseas operations, raising debt in currencies that are non-functional or non-domestic is also an option. There are also benefits of raising currencies in the debt markets, which aren't necessarily a functional currency because there might be pricing benefits. So again, you may be a UK company looking to raise sterling, but actually the euro market has more liquidity. It may have tighter pricing. There may be more investor demand for that particular issuer or company outside of the UK. So we've just shown an example of what a company would do in that situation. So we've got a company here who's raising a euro bond and it is a sterling functional currency and it wishes to swap those euros back to sterling. So appreciate there's a few moving parts on this diagram, so we'll go through them one by one. So step one in this process of a cross-currency swap is the euro proceeds come into the company. Step two is it swaps the euro notional amounts for sterling. So it's now receiving the sterling funding that's been raised. Over the life of the swap, again, the company doesn't want any exposures to euros, so it will pay floating sterling interest. It will receive fixed euro interest at every annual coupon date, and those coupons will be paid back to the bond investors on the notes themselves. Then at the end of the maturity, say in 5 to 7 years, the company will want to be making a sterling repayment. So that's step four. We'll take the sterling amount. It then receives the euro amount back and that settles the repayments of the euro bond. So this can be done on bonds, private placements, term loans, any scenario where the currency of the debt needs to be changed for another currency. It's a very simple, neat tool to remove exposure to the underlying currency and creates what we call synthetic funding in the currency of choice. Now, depending on which way round and which currency pair this is swapping in one direction from the other, may create a benefit in terms of the net interest rate payable, or it may indeed be a net cost, depending if the currency you're swapping to is higher than the currency you've started with. So we've just shown that here, and this is quite topical between sterling and euros. So again, 2 or 3 years ago, when we had very low interest rates, there wasn't a huge differential between sterling and euro rates. That has now created a bigger gap. So again, when you're looking at sterling interest rates over a 5-year period, they're currently trading at around 4%. In euros, that's down at 2.75%. So again, a material difference between those two. So if we go back in that scenario, you'd be swapping, say, roughly a 4% sterling coupon for a 2.75%. And this can be vice versa. You could raise sterling, for example, and swap it to euros to benefit from that interest rate differential. The final point I wanted to cover is pre-hedging. So that may be a term you've heard before. So whilst we're talking about interest rate risk management, that is very much on a position of something you already have, so financing that's already in place. There will be many instances where companies are planning to raise future financing or know that a refinancing is coming up in the coming weeks, months, or even years in some case. So the concept of pre-hedging then comes into play. And this effectively allows companies to forward lock in pricing on interest rates linked to a debt transaction ahead of time. So again, we've just shown a loose example here of an anticipated debt need is today. There is a period of time which we can say is 3 months. There is a known date at which the pricing of the underlying instrument, which might be a bond, a private placement, or a term loan, that is being executed within a few months' time. There is then a period of time to negotiate the terms, go through documentation, but the company at that point is already exposed to the future financing rate. So there are a number of ways in which the company can enter into pre-hedges, where it is forward fixing its financing costs ahead of completion. Then when completion actually occurs, either those hedges stay in place or they're unwound and the equivalent value is offset by the new financing. So again, this has become a lot more topical, mainly because market rates have become more volatile. It may be a case that board approval has been given for raising new financing at a certain rate. If we see a 50 basis point rise in interest rates, that can cause us problems for finance teams or indeed within treasury policies, trying to mitigate as much risk around the financing as possible. So again, we've seen a lot of companies looking to enter into pre-hedges, and doesn't necessarily need to be months. It could even be a day or two before a transaction where the company is trying to mitigate risk as much as possible. It may start to remove a portion of its interest rate risk leading into the final pricing call. I'm just conscious of time, Jean, so I'll probably pause there and see if there's any questions on the Q&A.
Perfect, thanks, Chris. We've not got anything coming through on the Q&A. So if you do have any questions, pop them in there and we can ask them to Chris. I did see a hand up, but I don't think I can unmute. Oh, am I looking at the wrong bit? Here we go. Okay, so the first one we've got here is with the pre-hedges, are they similar to deal contingent hedges with M&A transactions?
Yes and no. I mean, a deal contingent hedge is a form of a pre-hedge. So, sorry, let me just stop my sharing screen. So pre-hedging is any hedge that is a forward starting in nature aligned to financing. Deal contingent hedging is slightly different. in that there might be some contingency on a transaction happening. So you'll typically see that on M&A, and in that scenario, the bank is taking a degree of risk that the transaction doesn't go through. So yeah, a slightly different point on pre-hedging, but yes, it's one of the same in terms of executing risk ahead of the transaction completing.
Great. And a question, another one here. So are the FX rates for each currency pair of a cross-currency swap determined by live market rates, or is it a synthetic fixed rate?
Very good question. So within a cross-currency swaps, the FX rate is at the spot rate, so that is driven by spot FX rates. Your resulting then fixed rate on the amount you've hedged is determined by interest rate swaps. So it's a combination of both an FX transaction, but also the relevant interest rate swaps for the two currencies. But yes, the FX rate is set at this current spot rate.
Okay. And so a quick one again, just on the pre-hedging. So would there be any transaction costs associated with that?
Yes, so very similar to foreign exchange. So entering into an interest rate hedge will have a number of spreads chargeable. So there's a spread from mid, so that's your execution cost, and then there will be a credit cost involved, which is dependent on the size, tenor, currency. You know, lots of factors come into that. So those are the typical two spreads you'll see between a mid rate and then the final executed rate.
Great. And then a little bit more of a kind of macro question. So do you see Labour driving up interest rates?
That's a slightly political loaded question. I mean, look, it's hard to say. I think a number of economists have pointed towards, you know, a needing of change of government, and therefore that's a positive for the economy. You know, there's less uncertainty. It's a new direction. But certainly there are some others on the other side of the fence who are saying that, you know, that's a potential risk, and that could drive up yields. But as we currently stand, markets are relatively stable, and that's arguably with the knowledge that it looks like, you know, Labour will win the election. So I think that's probably one to wait and see over the next the course of the next month or so.
I think that's us. So we are all done. Thanks very much, Chris. It was a really insightful question, and as you say, very topical at the moment. Please do let us know if you have any feedback from today, and as well as any suggestions for future topics that you'd like us to cover as part of the Markets Masterclass series. And you can sign up to the mailing list to receive monthly invitations on the website. And if you do have any additional questions, then please feel free to reach out. And if you want to discuss your interest rate risk management, reach out to your rates representative. Thanks very much for listening. Have a good day.